I have some bad news for you. Your savings account is effectively paying you a negative interest rate. What does this mean? A negative interest rate means that you are actually paying to save money with your bank instead of your bank paying you. Savings accounts and bank accounts in general have, for the longest time, offered two things: a safe place to put your money and a small payment for allowing the bank to use your stored money. When you deposit money with the bank, the money doesn't just sit around in some vault until you spend it. Rather, your money is actually being used by the bank to generate more money. Banks traditionally make money by lending out deposits to other customers in the form of a loan, a mortgage, car loan, or personal line of credit. The bank, of course, makes its profits from the interest rates charged on the loan, so they compensate you with a smaller interest rate as a thank you for allowing them to earn profits off of your deposits. You, the depositor, get a safe place to store your money. The bank gets a large pool of deposits with which to loan out, and the general public gets cheap, available credit through retail banks. Everyone wins. This system works great during normal times, but now times are different. We have high inflation. Inflation can be thought of in two different ways. Way one is that inflation is an increase in the general cost of goods and services. If everything is getting more expensive and your cost of living goes up, that's generally bad for you. However, another way to think of inflation is a decrease in the purchasing power of your money. This is functionally the same thing as the other way of looking at inflation, but it helps us understand what's really going on in a high inflationary world. Since the cost of everything is going up, and we're assuming your salary isn't, because let's be real here, it isn't, your ability to buy goods and services on the same salary decreases. $100 of buying power last year may only represent a real-world value of, say, $90 of value in this year's terms for this example. So, how does this make your savings account have a negative interest rate, you say? To put it simply, the buying power of your money, or the value of your money, is decreasing faster than your pile of money is growing. If you put $1,000 in a savings account last year and inflation is at 8%, you would now need $1,080 in this year's money to have the same value as the $1,000 you put in last year. Anything less and your deposit has lost value. I can guarantee with 100% certainty that your savings account has not paid you an 8% interest rate. In fact, you are lucky if you're making 1%. This creates a situation where any cash you have is losing value day by day as inflation rises. If we look back at the two purposes of a bank account, one, a safe place to store your money, and two, a way to generate a small return, both are now in jeopardy. That small return a bank account offers during normal times is now actually a loss. And in terms of being a, quote, safe place to store your money, well, that's questionable too. Sure, your money won't be stolen from a bank, so you have physical security, but financial security is gone, as you are all but guaranteeing yourself a loss on the value of all cash you put into a bank. So, what's the solution? Well, there is unfortunately no silver bullet. The best case remedy in the long run is for banks to start paying interest rates which keep up with or outpace inflation. In the immediate term, while we all wait for interest rates to suck less, you can avoid as much value depletion as possible by holding as little cash as possible. I will put a disclaimer and say that the following suggestion is definitely not suitable for everyone, and investing, of course, carries risks. I have moved my entire savings account into the stock market, specifically into high dividend yield stocks. I keep enough money in my checking account to pay my bills each month, but aside from that little amount, I have all of my previous cash savings in dividend stocks. Certain dividend stocks are paying upwards of a 9% annual interest rate right now, far better than even the best high yield savings accounts. These companies are also relatively safe bets, as multi-hundred billion dollar companies rarely go bankrupt overnight. These funds are also easily accessible to me. Stocks aren't as liquid as cash, sure, but should I need to access some of this cash, I can simply sell my stocks and have the proceeds hit my account within a few days. For me, these stocks fulfill all of the needs and more that I would traditionally get from a high yield savings account, but with a much better return on investment as opposed to losing 8% per year. If you are holding a bunch of cash in a bank account and are getting tired of losing an annualized 8% value, it might be time to consider simply storing your money somewhere else.